Turn back, King. Good afternoon. Hello.
Good afternoon, Ms. Smith.
Hi. How are you doing?
I am well, and yourself?
I'm good, you know.
That's good.
Well, like I say, I want to make this the last class.
Yes, ma'am. I spoke with Ms. Dean, excuse me, last evening in regards to Saturday morning with the midterm, retaking of the midterm. She said, okay.
Mhm.
She said she spoke with you.
Yeah. Yep, she did.
Yeah.
Y'all have a whole week free, so everybody should do well because y'all have a whole week free.
Good afternoon.
Hi, how are you?
I'm good.
Good. Yeah, so y'all have assignment due when? Tonight, 8 or tomorrow?
Yes, ma'am, tonight.
I already marked it. I think 3 papers. Yeah, but I want to conclude tonight. Finish tonight because we only have that one chapter finishing off find securities, and we're going to work on that non-performing loan to do there. So we should finish tonight. So free, yeah, recovery of money. It is like non-performing loans. Properties are sold because of non-repayment. A lot of times people think when they buy and sell your house is just happen just like that. No, banks sometimes give you a long time, and some people are lucky because they're able to get refinancing with the bank. The bank able to redo their loans because they have enough equity in it. And then some people are not so lucky because either it's a divorce, separation, or people get houses, get mortgages to get a boyfriend, fiancés. It doesn't work out, and so one person is stuck with it, and nobody wants to pay. So at the end of the day, you might have to sell. So people really think getting a mortgage is kind of cool and easy. So many unforeseen things that happen. Yep. But it's two of you, so let's just see how many other persons is going to join in the next 5 minutes. If not, we'll just start and we will catch us up. Planning on stretching. Next week is the last anyway.
When is the exam?
The 28th.
The 28th, that's a Monday?
And you know the exam, all exams are face to face. And that's why I say when students don't do their part and try to do things on the wall, it causes problems a lot for others because before you didn't ever have to go to BIS. All exams used to still be online. The gal used to just monitor everybody. I guess something happened to change it. Yeah. Exams now is online. You have to go face to face.
Okay, Miss Smith, on the 28th, I will be coming back. I'm traveling on the 25th. I think but on the 28th, I should be back by 1 o'clock.
Yeah, the exam is not till the evening.
Okay, then. I should be back.
It's not until you yeah, until your class at 6. We kept 6 o'clock on the 28th. Miss Russell, you what For the assignment,
Yes, ma'am.
also, you know, the exam is on the 28th, right?
Yes, ma'am.
Today is the last day of class. So we're trying to finish chapter 11 and go on to chapter 12. Try to finish, so we shall have next week for your study period. And everybody should do well. I don't want to see no C's in the class. Like, I want to see A's and B's. Because like I say, y'all had a review sheet, so. Not sure if I'm giving y'all one. I'll let y'all know by Monday. I'll email y'all to let y'all know if I am. I'll send it on to you, the review sheet. But like I say, whatever assignments you get, you know, that, and usually I tell you what answers you got wrong, so you know what you have to do. It usually covers your assignments, and I may add one or a couple other questions in. It'll only cover chapter 7 to chapter 12, so it's not the whole book. It's only chapter 7 to chapter 12, because you've already had the midterm on 1 to 6, so 7 to 12 will be the finals. Okay. So, Estevo, you remember where we left off? I think we should be able to, we did the disadvantage and the advantage of taking security. So, and I told you all to just go over, peruse it, read it, so y'all could come back, so I could just sit back and listen to y'all. Tell me what's going on in finishing chapter 11, keybind securities. Anybody had a chance to actually finish reading chapter 11? Hello? Hello? Hello?
Hi, I'm Smith.
Yeah, just trying to find out if y'all had a chance to finish reading chapter 11. Hi, y'all didn't hear me? Action. Hello?
Hi, Miss Smith. Sorry, I was having connectivity issues. I started reading chapter 11, but I did not get a chance to finish the entire chapter.
Yeah, because we started it, so we're gonna just pick up from to key securities, key banking securities, because we started it, talking about why we take, whereby securities and stuff like that. So, yeah. So we'll just start. We talk about the advantages and the disadvantages of taking security. Yeah. So we'll just start by talking about the key banking securities. Um, so in effect, there is little that a bank cannot take as security, but certain assets are easier to take than others, and there is only a narrow range of assets that almost always form a good banking security. As we will see, when it comes to creating security over any asset, two aspects prevail: value and control. Good securities must have suitable value, and little untitled documents need to be deposited with the bank. While even intangible assets such as goodwill and the value of trademarks can have a fixed charge created over them. These are used only in rare circumstances. Most commonly, the key banking security is summarized in down below in 11.3. Will be so on. All of the securities listed in Table 11.3 can be deposited by individual, jointly, by partnership, or by companies. In addition, the security listed in 11.4 can be deposited as security only by companies. So there's a difference between the securities in 11.3 and 11.4. You see in 11.4, only companies can offer these as security. Then we see in 11.3 that life insurance, land, stocks, and shares guaranteed. The important thing to note is that each type of security has a legal definition, a separate legal framework within which it develops a different set of specified criteria that must be considered before the security can be perfected. And it says it's C, the perfecting security. Valuing security. Banks as lenders should view the securities in most cases as secondary form of repayment to ensure that repayment of a loan will be forthcoming in the event that the primary form fails. However, the security needs to be sufficient in value. Say, for instance, you get a mortgage. You get a mortgage for, say, 250,000. Get a land. The land is valued, say, 100,000. So you borrowed 150,000 just for the actual construction of the building. And say, for instance, you had the land, maybe the land cost, say, 50,000 or 60, because you had it such a long time ago. And you're coming to the bank to borrow, say, 250,000. An appraisal has to be done on the actual land as well as what is going to cost to complete the construction of the home. And when that is done, according to the loan that you're getting, the bank has to be totally secure. It can't be that you have a shortfall of 50,000, you want borrow 250, but when you look at the collateral, the actual building and the actual property, it's valued at 200,000. If the bank, if you start to say you finish the construction, you start to pay the mortgage, something happened, you can't complete the mortgage, but the bank lend you 250,000. But when they go to try to repossess the property from you, even the market value doesn't tell them. And because maybe too, because some persons, when they know they're not making a mortgage payment or they're not doing what they're supposed to do, what they do is that they don't maintain the property. So when the inspector go to do an appraisal for the bank to sell the property, what happens? It's undervalued. It's not the value is with the loan the bank gave. And when somebody is in default, right away, they're not paying any interest to the bank. So only thing is happening is they're paying just the principal to the loan, and only unless the bank refinance or sell the property. And a lot of times bank can take losses because the person didn't upkeep the home. So what happens to, they can't get the value of what the person loan is to, so that's why they have to charge it off, make provisions for it because they had a shortfall in the sale. So that's why banks have to ensure that they're totally covered when they're actually given a loan. So you have banking securities offered by individual partners or companies. You see land related to the mass test. You see land relates to land and all buildings or exceptions on it, depending on local law, can also extend to mineral deposits, but these are more often owned by government, limited in supply but long-term value improvement. Market of value depends on the usage, domestic or commercial, because you have or local location and transportation link, because you'll have a property located in, say, a Cowpen Road, which will not value as much as a property in Westridge or South Westridge. So here again, you have to ensure that if a building is put on this, because of the area, when if something happened and it has to be sold, that the bank can actually get what they asking for it because of the location. So the land also, it plays where it's located. Like now you have, before Carmichael was like, now Carmichael is a city. Carmichael is a Bay Street. So now people, the properties are up. If you even look for rental income in Carmichael, you'll see that rental income can go from anywhere from 900 to a one bedroom, and some of those not even furnished. And only thing included is water. So that's because the demand is so high, because Carmichael is considered a commercial area in some parts of Carmichael. And people like Carmichael because of the bus stop. You can get buses, easy transportation. Because, if you go live in a secluded off area and you don't have a car, so, what do you do? So people like Carmichael because it's easy, accessible to catch a bus. Ownership and transfers normally protected by law. Sale transfers of ownership can be costly. And you have life insurance, which we talked about before. Life insurance, people nowadays can take out term life. A lot of people just take term life insurance because they said they just need it for the term of the mortgage. So if the mortgage is 25 years, they can take out a term life insurance, which the payment is less for 25 years. So yes, so we can do that. So people mostly now take out term life insurance to cover their mortgage. And persons who have always had life insurance can actually have that signed over to the bank, because the bank on that insurance will be lost pay. If the insurance is say 300,000 or 500,000 and your loan is 250, the bank is lost pay for 250,000 of that, and whatever the difference is, whoever is made the beneficiary on that insurance gets the balance after the bank is paid out first if the person dies. So insurance policy, valuable contract between life office insurers and individuals, under which in exchange for payment of a regular premium, the life office will provide a lump sum on death or terminal illness of the client. Market exists in endowment policies which build up investment values over time, but not in whole life policies which simply pay out lump sums on death. So you can have an endowment plan, and a lot of people take an endowment plan for for their kids. So when their kids are young, they take out an endowment, so they do it for college fees and stuff like that. So, yep. And so life insurance, like I say, we have a whole life where if the person died, the lump sum is paid out, so the bank can be paid off as long as they're listed as lost pay. And so that's one thing when having bank securities, as customers have to do an assignment to the bank. They have to assign that portion of their life insurance to the bank. So it's not just taking out the insurance, they also have to have assignment form completed along with all their mortgage documents, which is all kept in a collateral file, not the actual mortgage file, but the actual collateral file, which is locked away. Transfer of policy benefits to the bank with fiduciary interest in the clients is possible. The transfer to other third parties with no such interest is typically against public policy. Ownership and transfers are protected by law, and transfer costs are minimal. Stocks and shares, people buy stocks, people have shares. So, some shares are valued so much. Some people have so much stock. So their shares can be valued. Some people could have shares valued up to 200,000 and 300,000. So you can always use that too as, as a security. So publicly quoted stocks and shares have a ready market and are easy to value from published stock exchange data. Similarly, ownership and transfers is protected by law and the cost of transfers are minimal. Guarantee, we talked about that before, how someone can guarantee as a promise, okay, Joe Doe got a loan, I am guaranteeing this loan for this person. So if this person default, I will be responsible. So that is also a guarantee. It's kept, it's an asset to the bank. So it's kept in the collateral file. It's a security. So it's kept in the collateral file also. And like I said before, all of these documents are filed in the collateral file and filed safely away in a safe or locked fireproof cabinets. Most people have a book vault with where these are actually locked, just like a cash vault. They have a book vault where it's locked away. So if fire or anything happen, they're still secure. Then the other securities that only companies can give, a floating charge, covers all assets in a company balance sheet, not charged elsewhere. Companies is free to deal with assets in normal courses of business until bank makes demand. Notoriously difficult to value because value of asset changes constantly. As with most charges given by companies will be void unless the registered or relevant company's registry. Registered charge ranks ahead of unsecured creditors in most insolvency jurisdictions. Fixed charge on book debt, typically used for trading companies with debts owned by other businesses, not consumers, because it allows lenders to control proceeds of the company's book. Lack of control of debt proceeds can avoid the charge or downgraded it to a floating charge. So like I say, these here, I've hardly heard of them, but these are mostly used by companies. So people, I guess, who deals mostly with a lot of commercial companies and commercial loans, they can use these fixed charge or the floating charge. The best way of securities are characterized by readily available market information, commonly valued by professionals and have stable or rising values. In the case of life insurance, all banks recognize the fluctuations of values that occur particularly in short term. To combat such fluctuation, banks employ lending margin, which represents a buffer to absorb fluctuations in value, disposable costs, and accruals of interest if a loan is in default. Bank, bank can also employ a worst case or on concern valuation, whereby, for example, example, the value of an asset is based on liquidation value. And if the company or the individual was insolvent and a sale were to be effective immediately. An obvious use of lending margin is the domestic mortgage for home purchases. In the context, the margin is known as loan to value ratio. If a bank offers a mortgage for a maximum of 80% loan to lending value, this gives it a 20% loan margin buffer. Typically, property prices fall in recessions while loan defaults rise, so the most likely time when the securities will be needed is when prices are falling. In some jurisdictions where consumer credit regulations is tight, the government will also set maximum LT loan to value for major asset purchase such as apartment, cars. Germany and Singapore are example of regulation loan to value. So like when you get a loan, the first thing the bank is say, persons who don't have properties and they say they just going to buy a house outright. So they said the bank usually tell you, okay, you have to come up with a certain percentage. So they will lend you a certain percentage, like they say 80%, but you probably have to put that 20%, 10 to 20%, and in putting the 10 to 20% to get the loan, you also have to worry about closing fees. And we know after VAT, the government stamp tax is, you're paying so much government stamp tax when you're getting a loan, and it's according to the value of the loan. So imagine taking out a loan for 300,000 and you have government stamp tax, which is 10%. So, and then you have the lawyer fees, which is a certain percentage. Some lawyers, because they may know you, they can give you a percentage of 1.5, 1.8, or they can give you 2%, some maximum 2.5, so it's according to the lawyer that you go to too. So closing costs could run you, closing costs along with the down payment could run you anyway into some 30 or $40,000. So it's very difficult for younger persons trying to save and to get there. And especially in the climate we live in now, where inflation is so high, you can go to the food store today and the price is one thing, and you go tomorrow and it gone up at least 10 cents more. So when you're thinking about getting a home, it's really a long journey to try to save, unless you lucky that you have parents who would give you a gift and say, okay, this is my gift for you to, get a down payment and help you with your legal costs to get your home. Some people have that, and then some people have to actually really struggle to get it. And then, as we know, with the government homes now, it's a long list. And even the government homes, I remember back in the days that my mommy got a house in 1990, I believe 90 something, and 80 something. And back in the day, she got a house in Elizabeth Estate. When she got that land and property, was 47,000. Nowadays, and that was a 3-bedroom with a big property, she could have put a whole 3 apartments on the back where that property was so big. The house was tiny, but the property was very big. So you're able to expand and put at least three apartments with 1 bedroom in the back of the property. But now the government houses are costing with the property $167,000. And we know it's very hard for people to qualify, because we have a lot of persons who, before trying to get a mortgage, they tie themselves up with a lot of consumer loans, which we spoke about before. They tie themselves up with a lot of consumer loans. So when they actually decide to go to the bank to get a home, they don't have no money saved for the down payment, no money saved for closing costs, because they have a consumer loan for 80,000, which they have nothing tangible to show for it. There are some banks who are giving loans just for properties. I know Fidelity is one of them. You can get a property loan, and I'm sure other banks too, but that was something I know before I left, they were pushing, so property loans. So, but a lot of people can't qualify for a government house. I remember the government talking about that when they actually tried to pre-qualify persons. A lot of people couldn't qualify when the former party was in the FNM, and they were doing that project somewhere out west, which the new government stopped. But they would tell you that a lot of persons couldn't qualify because they were just trapped down in consumer loans. And I think a lot of times younger persons and even middle-aged persons don't consider that when you tie yourself up in a lot of consumer loans, when it's time for you to actually get a mortgage loan, it's very difficult because you have to find the money to make the down payment. Then the bank have to also take into consideration when they're giving you the mortgage, this this consumer loan you have and your debt service ratio could, some banks, like we were talking, and one of the students said that they go up to 50%, some banks go up to 45, some probably go up to a little lenient and again a 52%. But still, with all of that, if your salary cannot accommodate consumer and mortgage in a separate arrangement, they try to consolidate your consumer loan with your mortgage loan. And some people, the debt service ratio is very high because they don't have proper savings. So if they don't have proper savings, it can, help account for, their down payment. So a lot of people can't qualify to get a home. So the bank has to always ensure that their security is 80%. You have to put, they have that 80% that the bank will lend you, and you have to have that injection of that 20%. The bank will never lose. The bank always wins. Like I talked before, before anything, go to your principal when you get a loan. You look at an amortization. It goes to the interest, and the majority of money goes to interest for the first couple of years of mortgages. If you get a mortgage for 25 years, you know that at least 12 or almost 15 of that, you'll see money, majority of your money going to the interest instead of the principal. And then too, when you take out a mortgage, you have to also incorporate house insurance. And I can tell you as of today, especially because there's so much disasters happening with these hurricanes, house insurance is really high. Everything has gone up. So if you want to insure your house for 500,000, that's like almost $7,000 for the year that you have to pay to include disaster. Now, if you're just going for fire, that's fine. You're only going to probably pay 1,800. But if you have to insure that for disaster, catastrophe, anything happening, yep, you're going to have to insure that for at least, you're going to have to pay at least $8,000 for house insurance. Developed land is one of the most sought after securities, since there is often a ready market for developed land, although ownership can be difficult to establish in some countries. With a growing global population and high demand for housing, world property prices have risen in the long term. Figure 11.1 illustrated the global residential property price since 2000. A figure in which the impact on the property prices of 2007, 2008 global financial crisis, subsequent credit crunch is clear. So, like I say, I could give you an example of the Canadian market. My son lives in Prince Edward Island in Canada. He was in search of a house, and we saw several. And because there's such a high demand, because a lot of persons just move into Canada, even if you go to Toronto, you go to Ontario, you go to Hamilton, you go to Montreal, it's a high demand. And persons who have the cash is the ones who can get the land, who can get the real estate. And I know I read an article in Prince Edward Island. It talked about persons who just coming in and just buying the land cash. And so you would have the foreigners like the Chinese and the Indians, and they have the cash money because, they lend money between each other. So they have the cash money. So if you see a house, my son saw a house and we said, oh, when we looked at the house, it was costing 155. And I can assure you the structure of their houses compared to us, no comparison. So you look at the house and you be like, what? That costs all of that? So we saw it, 155. So he was supposed to go and see it. But the real estate called him and say, oh, somebody bought it cash. Right off the bat is the Chinese or the Indians with the money. So they come in and they could just buy a house. But PEI, Prince Edward Island, now saying persons cannot no longer come in and just buy a house like that. They have to have permanent residence to be able to buy, because they were just having people who just come in and just buying all the houses. So even the Canadians who live there weren't able to actually go to the bank and qualify for a house. So we saw another house for 49,000. That was good. And he said, okay, mommy, I going to see the house on Thursday, today, no, yesterday. And then he said, mommy, the real estate guy called me back and said, and the house went down from 149 to 134. So that was good. Real estate guy called and said, somebody bought the house again. So money, as long as they permanent residents and they have the money or could get private financing and get the money from someone and just buy the house, that's what's happening. So even in Toronto, like, over here, if we see a house and they say the house costs, the house's value, when an appraisal is done on it, the house is value 500,000. So we could say, okay, I'm going to get the appraisal done. I'm going to the bank and I'm going to get this loan for 500,000. Well, not 500, because you have to inject your 20% of your closing costs, 10 to 20%. So it's not like that in Canada, like up in Toronto and stuff like that. If you see a house for 500,000 and you want to buy it, do you know you have to bid? You and a couple other people are bidding on this house, and the house may cost 500,000. But at the end of the day, you have people bidding up to 700,000 for the house. So you put the bid in, somebody else put in a bigger bid than yours. Mind you now, the house is selling 500,000, but because people having to bid on it, the person who bid the most get the house. So people could bid up to 800,000 on a house that they're asking 500,000 for, because that's the market in Canada now. Yeah, so here we have so many houses that is not occupied because, like we talked about before, so the bank has it, repossess it, which we will see in chapter 12, which talks more about non-performing loans and how that work and why people get evicted out the house. Okay. In the mass test term, it is the difficult nature of this valuation that causes both guarantees and floating charges to be weaker securities than saying land. The value of both guarantee and floating charges can be estimated, but it is not until they are called upon that their true value emerge. Unless supported by good security, the value of a guarantee lies in the individual or the company's ability to pay. Like we know, guaranteeing a loan, you have to, some people guarantee, they have a company, some people have a lot of liquid cash, some people have a lot of asset and land, and so they're able to guarantee. Some people put up their fixed deposit, like I said before. Some people can put up more land. And so if the person defaults, well, the bank can go after them for the land and the person land who defaulted on their payment. Moreover, it's easy to take a guarantee, but much more difficult to realize it. Similarly, the value of a floating charge requires when a company is in a financial trouble, we will be limited by the disposal of stocks, that running down of debtors, and failures to maintain movable assets, among other things, prior to the company's failure. Just as lending itself must consistently be monitored, then it is important that lenders monitor securities, updating valuation regularly if it is to avoid unwilling surprises should the security be called upon, right? So like I say, that's where banks have to ensure that property valuation is what it say it is. And that's why they have an appraisal done on it to say, okay, this property is valued. Because you have some properties in the Bahamas, and like I talked about before, in some areas value a certain amount, and if you get a loan and the property isn't, it's not a chance that you could sell the property for what you get the loan for, then the bank still loses, even the customer loses. So you have to ensure that before you purchase a property that an appraisal is done on it. Even if you have the full cash, make sure an appraisal is done on it to make sure the valuation of it, if you choose to want to sell it, it is marketable, that you can sell it for a good price. Because like I said, back in the days, I bought a property in South Westridge for $40,000, and I think it was in '92 when my children were ready to go off to college in 2007. I sold it, but I bought it then. It had no infrastructure, but I sold it and I was able to sell it for 165,000. So that's what you have to buy things that will go up in value. And that's why when you purchase a car for $50,000, 5 years down the road. How much I got value? You ain't getting that 50,000. So that's why we always say car is dead investment. If you want to invest in something, you just need a car to get you where you have to go. If you want to invest in something, invest in properties. Properties appreciate. So you'll always be able to sell that property for more than you purchased it for. So always invest in a property, be it on the family island, be it here. Invest in properties because you can always hold it and save it. And at the end of the day, it will always go up. Properties, most areas don't devalue. So it's good to hold properties instead of taking 50,000 and invest it in a car, and the minute you drive off the lot, it's no longer worth 50,000, 20% less. So your car's gonna be worth 80%. Typical consideration when taking UK lands as security: the IVA, deposit, inspection, valuation, authorization, notification. So they're telling you this is what happens in the UK. Deposit. Deposit are the original deed certificate or duplicates. Has the land registry detail been accessed and updated? Are the deed certificates completed? Are previous mortgage now repaid? And like I talked about in the last, when we were here in the last class, I talked about documents being, it has to go to the registry. And back, I think a lot of I saw where a lot of lawyers at one point weren't sending the documents to the registry, and then we know the registry had a backup because they were sending stuff off to be registered, to get stamped and registered. And so it was a whole backlog, but you found that a lot of banks realized that documents were still at the lawyers even when people completed their loan. And so the satisfaction couldn't be done. So you have to, when a loan is paid off, a mortgage loan is paid off, it has to, the bank where the loan was have to actually do a satisfaction for that customer to say, okay, we no longer have no claim to this property. And so a satisfaction have to be done. Senior employers of the bank will be the ones signing off on that satisfaction. That satisfaction have to go to the registry to be stamped and recorded. So, and like with anything, you could go to the registry. You see a property on as long as you know where the description, and you could find the lot number, whatever. You can go into the registry and you can find out just who owned the property if you're trying to buy it. So, most all documents should be stamped and recorded in the registry. So you could always go and pull it up if you choose to. Inspection. Who owns the security? Who has legal rights of occupancy, legal interest in the property? Are there any prior charges? If so, how much is outstanding? And can this charge be subordinated to that of the bank? Which searches need to be made? Local search can reveal mining works, right of assets, planning permissions for redevelopment. Do the providers have the power to create a mortgage? This can be an issue for a corporate depositor, although protections for third parties dealing with companies good. Are there any impediment to create a charge? There may be covenant affecting usage of the property. And like with anything, you have to do due diligence legally, because we know a lot of people have false documents saying, oh, this is my property. And so you have to ensure that you and three other people ain't buy the property. So that's another thing. And like they say, for inspection to ensure that the property, you can live on the property, because you know somebody's property full of water, and when it rain, you can't even get in your yard. Then we have valuation. How much is the security worth? I talked about that before, ensuring that you're buying a piece of property, make sure that it's worth it. How much years down the road if you choose to buy it for just to say to have it, like some people have it just for when their children ready to go to college. How stable is the value and how easy, costly is it to value? Remember that for properties, the insurance value that is the necessary part of rebuilding in the event of destruction will be different from the market or the for sale value. Right, because the bank will say, okay, I sell in your house because you owe me 500,000. I sell in your house for probably 700,000, but your house value $1 million. But the bank only won't get paid off, and whatever other little fees there, you may get a couple dollars back to you. And that's when they say a forced sale. A forced sale is when the bank takes your home because non-payment. So it's a forced sale. So they don't have to sell it for what the market value is. They sell it to get their money back, pay off any little fees that need to be paid off, and a little bit left over. Then you're able to get that little bit left over. But the bank, when they force sale, they just want to actually get their money. Authorization. Who must execute the security? Owner, those with an interest in the property, and the mortgage. The mortgagee lender must authorize the security. In case of corporate borrowers, is a company seal needed? Any one of you know what a company seal? Have you ever seen a company seal on a document? Like when they have the memo of arts, article of association, stuff like that, or the directors, or the papers that the bank would ask them to fill out to open an account. Have you all ever seen, any one of you know what the seal, a company seal is? Hello?
Yes, I've seen one before.
No, I've never seen one before.
Yes, I've seen one before.
Yeah, because they have to put the company seal, and that's how a lot of banks today, especially you see now, they have a legal team on board. Before they never used to have that. Everything used to be outsourced to different lawyers, but now they have a legal team on board now, so they have people perusing their documents, especially when they come from the lawyers or other, when somebody getting a property or mortgage loan. Banks now have legal departments, so their attorneys, their lawyers actually peruse the document, and anything the lawyer firm may have missed, or the client lawyers might have missed, the bank is able, their legal team will pick it up and question or forward back to the law firm for amendments. Authorization. Who must execute the security? Who owners, those with an interest in the property of the mortgage, the lender must authorize the security. In case of corporate borrowers, a company seal needed. Have a signatures between being formally identified to avoid forgery. Has independent legal advice between offer and take up. Notification. Does the charge require registration? In the UK, the answer is yes. For all legal charges over land, yes. Even here, we have to register our document. We have to register any properties, mortgages. It should be registered in the Registrar General Office. Yes, it has to be registered. Like I say, I'm not sure now how the registry is because it's been backed up, so I'm not sure. Where should the charge be registered to protect it? Typically, this will be in the appropriate district lands registry. For corporate depositors, this will include companies registry. So we see that, everything has to, the DIVAN, Devin, deposit of the title, inspection of the title, valuation of the asset, authorization of the mortgage or charge, notification that a charge is held. Ms. Minus, could you continue for me, please? Procedural steps in perfecting security.
Okay. The procedural steps in perfecting securities. This chapter closes with a look at the steps that must be taken if resort is to be made to security in the form of land, life policy, and floating charges in the event that a borrower fails to make repayment of the advance. Typically, this is a legal and practical process. A simple mnemonic divine can help us to remember the necessary steps as follow. Number 1, deposit of title documents. Number 2, inspection of title documents and searching. Number 3, valuation of the asset. Number 4, authorization of the mortgage or charge. Number 5, notification that a charge is held. The first, fourth, and fifth steps, deposit authorization and notification, relates to a bank's need to control the asset, while the third self-evidently relates to value. The second step, investigation, has implication for both value and control. Table 11.5 summarizes some of the typical Devane considerations when taking UK land as security. We are now poised to tackle the final chapter of this book, which looks at the bank under adverse circumstances. What happens when loans turn bad and the borrower cannot repay them? This is the eventuality for some security, for which securities is taken, but banks also need to consider the steps that they will take in relation to unsecured loans.
Thank you. Any questions, any
Welcome.
concerns, anything you have to add? Any one of you?
No, ma'am, no questions.
No question.
No question.
Right. So now we move on to chapter 12. And like I say, chapter 12 talks about recovery of monies. And as we know, I think we're doing better now with non-performing and, a lot of people losing their homes because banks are trying to work with them, persons who want to work with the banks with recovery, doing refinancing, reconstructing their loans, So a lot of people are still staying in their homes. And then, like I say before, we have a lot of people who are actually losing their homes. If you look in the newspaper, sometimes you'll see, say, a bank in the Bahamas, and you see a bank in the Bahamas, and then you see the customer. So it's like, it's sometimes you'd have a whole 2 pages of just houses which are repossessed, and persons, the bank got charged over it. So the bank won, going to court. So the person has a certain time to leave the home because the bank has the right to sell it. And like we know, a lot of banks today do not allow customers to stay in the house, which I feel shouldn't happen, because when they allow the house to just stay there, it gets run down. I have a house next to me, Jesus, the bush cross. I'm running straight across in my yard. Every time I have to go chopping the bush off the fence, it's just like the whole back door, the bush go up to the whole back door, and they're doing nothing about it. The yard is so high, and that causes rats and rodents and they running across in your yard because coming from over there, you know. So and banks don't do a good thing about maintaining the properties. I remember back in the days when a bank had a house up for sale, uh, or repossessed the house, the bank made sure the yard was always kept. It's no longer they do it. Everything just grow up. So you know, it's just it's really sad to know that you've invested so much money in a house because circumstances happen. Now, mind you, some people just don't care, so they don't pay the mortgage. But then you have some people who are actually genuine and things happen, death, sickness, loss of job. So things happen and they just couldn't afford to do it. And that's why going back to talking about savings, as I always said, it's always advised that you should have at least 6 months savings. So if something happened, you're able to still pay your mortgage. And a lot of times people don't understand. If you don't dug the bank, you know, because every time the bank call, you're telling someone, oh, I'm here. If you go to the bank, talk to the bank, say to the bank, this is my situation, this happened, I'm not able to meet my commitment, but this is what I can pay. And once the bank see that you're trying, you know, your payment might have been 1,000, but you're able to bring 500. They see you trying and every month you're consistent with that $500. Then they could say, you know, this is a candidate who is circumstances happen. We can help them, you know, you allow them to pay a certain amount, then you say, okay, we will do we will restructure your loan. And so when people decide to dug the bank instead of actually sitting down with the bank, that's where the problem happened. And that's why we have non-performing bad debts. That's where a lot of people lose their homes. So in this chapter, we will talk about recovery of money. Mr. Vo, can you read the introduction for me, please?
Yeah, sorry about that.
Mhm.
Introduction. No lender wants to prepare for the event that a debt becomes distressed and unrecoverable. And yet that is what capital adequacy in respect of credit risk is all about. See chapter 5. In this book, we have so far described what for retail bank is the most common experience. Loans are agreed and rapid security. Loans are agreed and rapid. Security provides insurance that is never needed, and relationships are steadily built with customers over the course of an average life cycle. When considering bad debt, and in the worst case scenario, loss from a bank from the perspective of the lender, it is sometimes easy to lose sight of the customer, whether individual or small or medium-sized enterprises, SMEs, as people. When bad debts arise, it is most commonly the result of financial difficulties caused by unexpected hardships such as illness, loss of employment, divorce, or even death. Fraud plays a part in only a majority of instances. It is therefore essential that lenders behave appropriately in the event of loan defaults and financial distress. This this final chapter in the book focuses on some key concepts in debt recovery, legal and practical steps that will help the well-prepared retail banks to deal with what one reports into insolvency law and practice called in 1982 the casualties of credit, Proc 1982. While some specific legal jurisdiction will be mentioned, this chapter aims to outline some of the general legal principles and bind the retail banks in this regard, and to explore the options that banks have to recover bad debt. When you have studied this chapter, you may want to test your understanding by considering the case studies in Appendix C.
Debt recovery, key debt recovery and insolvency
Key debt.
concept.
Oh.
You could go, Ms. Devo, because it's only 3 or 4 of us here today.
Okay. Key debt recovery and insolvency concept. There's only really one reason why loans are not repaid. The borrower simply does not have the cash, asset, or additional credit facilities to make repayments on a loan as they fall due. This is a common definition of insolvency estranged in law worldwide. Thanks to the global trade and the effort of world trade bodies and insolvency professionals, the key concept underlining debt collection procedures are fairly uniform. The common features of debt recovery and insolvency systems include that law provides for an end to a debt contract. Debt is a civil rather than a criminal legal matter. The property rights of the security holders are upheld above claims from the unsecured debt. Debt collectors and court action against debtors is competitive, that is, first come, first served, and certain assets such as family homes are subject to a measure of protection. All commercial systems and economies need to have some way of dealing with non-repayment. Ultimately, the end of debt contracts is a legal issue, and we look at this aspect later in the chapter. Although it is often the duty of the borrower to repay a loan, it is usually the lender that will take the first step towards recovery in the event of default. If all repayment avenues are exhausted and the loan has yet to be fully paid, a loss is to be applied to a lender's balance sheet. For banks, this means ensuring that they have adequate amount of capital to absorb essential losses, as we saw in Chapter 5. Fortunately, horror stories of capital punishment and execution for debt offenses have long been consigned to history. The UK saw its last hanging for debt. For debt.
Whoa.
19th century.
Whoa.
Afterwards, the UK and the United States abolished jail sentence for debt. But someone in prison is hardly well placed in more fact to repay the debt owed. In other jurisdictions, however, such as United Arab Emirates, jail sentences were given in debt as recent as 2013. And it is worth remembering that even in the UK, defying instructions to attend court for related matters can result in imprisonment. Depending on the prevailing legal system, security holders, that is, those with a charge over a valuable asset belonging to the borrower, we see their rights upheld in the event of a loan default. Most insolvency systems are such that insolvency proceedings cannot diminish rights held prior to such. In cases of default or in unsecured debt, there are legal protections in places for homestead, US terminology, or marital home, UK. But if a lender has a charge over a home, most commonly in relation to a mortgage loan, then the homeowner's failure to make repayments will end in their eviction. In corporation insolvency, the rights of holders of floating charges in particular can be diluted. In Germany and the UK, as well as other jurisdictions, such as France, employees are given priority over trade creditors, including lenders. Although many borrowers have multiple debts, the lenders can take individual actions against the borrowers in court without having to liaison with many or make agreements with other lenders. If the courts grant a judgment against the borrower and the law enforces this and collects what is owed, then the lenders keep what it has recovered. It is under no obligation to share their proceeds with other lenders. In many cases, however, the pressure of multi-lenders lead borrowers to seek bankruptcy or an informal agreement to repay creditors, such as individuals, voluntary agreements, IVA. In this instance, lenders need to be programmatic about sharing both the benefits and the loss involved.
Thanks. Now, y'all listen to this, right? It says back in the days, even up to 2013, people go to jail because they pay their mortgage. Have you ever heard of that? You get in prison because of that. Boy, plenty of people be going to prison here because guess what? The banks have so much houses that they have for sale. And like I say, it's not always that people intentionally not pay their mortgage. Like I said in previous classes, sometimes COVID, Dorian, all of that created situations that people who were good pays could not just pay the mortgage because they didn't have the money. They got laid off from their jobs. And so, and then we, like I said, we have a lot of situations where we have people who are married and they or persons is responsible for the mortgage and then something happened and they're getting a divorce. One person want to stay in the house and not leave, but the deduction is coming out another, the wife's salary, but the husband don't want to leave. He's not working, he don't care. The wife having to pay it. So the wife decided that you live in the house, I paying it out. And sometimes the bank will not stop the payment, even though the wife is not living in the house, the payment continues because the husband don't care and he stays in the house. The wife continues to pay until she probably say, well, I filing for divorce. So we can see if y'all get the money of my salary because I get a divorce. So you're gonna have to sell the house. And sometimes that's the only solution to that person not having to have that salary deduction comes from their pay. But here again, like I say, when it comes to non-performing loans, it happens where customers just realize that some of them, they put themselves in it and they do things that, hey, you couldn't afford it, but you choose to say you work for another company and what happens? At the end of the day, you have to pay that mortgage. Whether you choose to have a friend or somebody who have a company say you make $800 when you don't, and you only make that $2,500. At the end of the day, when the rubber meets the road, what's going to happen? You only can pay from that $2,500 that you make. That extra $800 that you added to your salary for the month isn't there. But that's what the bank took into consideration. Your little part-time job and your full-time job, and your part-time job really didn't exist. But you had somebody who had a company say, I work for you part-time, and this is what I make a month, when it's really not the case. And like we know with banks can exhaust every avenue before, they just give up. So, and a lot of times they give customers the opportunity to, like I say, to get their loans rewrite. And sometimes customers rewrite their loan. And then because a lot of times people don't put priorities where priorities should be before they say, I have to pay that mortgage, or just like they talk about BPL. I know I have to pay BPL, but what happened? Girl, I going away. It's the BPL, go wait till I reach back. When you reach back, the light off, then you go into BPL, crying on them. Oh, I don't know. I need to make a payment plan. The BPL say, no, you can't because you're always doing this. It's the same thing with a mortgage. People seem not to put priorities in the right place. And like I say, sometimes it's not that people are not trying, but you have some people who are actually genuine, and then you have some people who just don't care. Well, I have to pay the mortgage. Child, I want to see them sell this house because you know house take up longer to sell, and they forget that the bank can evict you out the house. Like the court will say, once the court give the bank the right and give them judgment over the property, the bank give you a certain time to leave. And if you have tenants, they also give the tenants a certain time to find someplace else to go. But the bank will put you out. They will evict you. And in the UK, what? Fortunately, horror stories of capital punishment and execution for death offense have long been consigned to history. The UK saw its last hanging for a death offense in the early 19th century. You could imagine over here, we don't even want to hang somebody for killing people, but these people was hanging you for not paying your debt. Now that is amazing. I have never, this is my first time. This is a new chapter. I've never seen the other book that I was using didn't have this chapter. This is a new chapter that was added. They say soon after the UK and the US abolished jail sentence for death for someone in prison is hardly well placed to make effort to repay the payment. Yeah, because if I'm in prison now, I can pay. I can't pay. In another jurisdiction, however, such as the United Arab Emirates, jail sentence were given for death as recently as 2013. So I don't know if it's still going on. Boy, that would be something if it's still going on. But like I say, whether it's the marital home, and like we know in most cases, when it is the marital home and people get divorced and are separated, and one person, like I said, live in the house and the other person has to rent, eventually they get a divorce, and the bank nobody wants the owner to pay, so the bank has to actually sell the house, and the person who probably was living in the house who wasn't paying nothing, the bank evicts them out. Like I said, they give them a certain time period to actually leave. So, and then you drive around, you'll see where it's a bank repossessed house, because you'd see they're boarding it from the inside. Before they used to actually board it from the outside, but now I guess a lot of people were still going back in the house, because we have people who did that, who were going back into the house, even though the bank put them out, and then neighbors have to say, oh, that person, go to the bank and say that person got evicted, but they living in the house, because that situation happened next door to me. They got evicted. The guy, he was living in there and he had like, must see 10 dogs. So anytime anybody come there, if the bank came or the police came, he had the dogs them tied, so you couldn't even come in the yard. And all the dogs running around in the house, and these weren't just regular dogs, these were pit bull dogs. So people do that. And so that's why now they boarding the house from the inside, because they didn't board up the house. And so now they board the house from the inside, so you're not able to get inside. And then we have, like, I know before we had Bahamas Mortgage Corporation, where nobody is leave the house, because they would say all these houses for sale. And when you go to view the house, I don't know if the process is still the same, but when you go to view the house, the customers look at you like, oh, I get this house, my representative put me in here, I leaving. And so even though a lot of times mortgage corporation have these houses for sale, a lot of them, they don't get sold because the people ain't leaving. So even though eviction, you put them out, they, it's like, I don't know, like I say, if the situation's still there, but I know before, you go talk that you're going to buy one government repossessed house. You wait years before the people move out the house. The cost of non-repayment of loans. And like I say, we know people get in situations where it's no fault of theirs, but things happen, climate change, inflation, loss of job, sickness, death. Things just happen, so people not able to pay their mortgage. Very few bank customers who borrow will either take a loan or a credit card without the clear intentions to repay. all and any borrowing on it. There are some fraudsters who do just this, using false and stolen identities with banks can reduce fraud by checking borrowers' background fully before offering loan. I don't think we have that situation here because I assure you that the banks do their due diligence to ensure before they even grant a loan. And granting a mortgage loan to a customer, even a consumer loan. And guess what? Believe it or not, when they talk about fraud, yes, they do have that. You have some situations where you have persons even working for government. They use the letter that they would have probably gotten before, or have a friend who could do a letter for them and sign it off and send it in as a salary deduction. Yeah, their salary deduction. And not until a lot of times people don't understand, even though the bank may give you a loan and they get all these documents for you, people don't understand that the bank still do the background check. So they will still call your employer to say, okay, I just call in to confirm I got a letter. So and so work for you, when they apply for a loan from us, and we got a letter from and so sign it. Can you confirm? And then the HR person will go and look and be like, we ain't never do no letter. No, we can't confirm that. And when you come to find out, it was fraud. So people doing that, people does that. I've seen that happen. Yeah. So people are doing it. I know in a company that I work for, one of the young ladies, she did that, want to get a loan, and she was responsible for typing up the letter, so she did it for herself. Didn't know the bank would call HR, and yeah, she lost the job. You know, the bank do confirm. People don't understand the bank is going to confirm with your employer because that's a policy and a procedure in most bank manuals, that you have to confirm that the person is still there, and the letter did come from HR, and HR confirmed. Whoever the person is confirmed, yes, I did a letter for so and so. Yes, I can confirm they work here. This is their salary. Yes. So a lot of people not privy to know that still happens, you know. And I guess too, with the credit bureau coming into play, like Ms. DeVoe say, hopefully by next year, 2025, you know, that is in full swing, where full approval is done on it. So it's, you know, it's legal, and people, you know, persons getting loans can't say, oh, you can't judge me on that because it's not approved yet. So hopefully that'll come into play soon. We must remember that loans are always repayable in the future. And then the future is uncertain. Yes, we don't know. We could be here today and we could be doing fine, and tomorrow something else. The further we look into the future, the less certain outcomes will be. Well-informed lending and cost-effective monitoring of lending, as outlined in Chapter 10, can reduce risk to some extent, but the unexpected event or variable beyond both borrower and lender control will always undermine the best laid plan. And that is true. Like I said, no matter what we plan, things happen differently. Figure 12.1 echoes the framework set out in Chapter 1 in an attempt to illustrate the theme relevant to the cost of non-performing loans. While the emphasis here is on consumer debtors, the framework will equally be well for businesses and corporate debt. The potential source of loss of income or livelihood, or even a reduction in the value of asset used to secure the repayment of the loan, are many, are general. And we look here, we say external world, local environment, household, individual, impact, long-term, medium-term, short-term, immediate, causes, and these are causes of non-repayment. Downturn in the economy, yes, downturn in the economy, interest rising, inflation, all of that can, you know, stem to non-performing. Downturn in the economic condition, limited availability of local employment, the vulnerable of an industry to competition from abroad and technology-based or legal change can all have an impact on the income of individual borrowers. Social pressures can also impact an individual willingness to take a credit. Welfare system around the world can protect family homes, but they rarely stretch to cover loans for other purposes. Closer to home, and normally with more immediate impact, are sources such as personal health problems or health problems of a family member, early death, the demand of raising a family, a divorce or separation, which I spoke about. All of these things create declining of your age, old age, inherited liabilities. Because, like some children, their parents die, they live in the house, they didn't know that mommy, daddy, they us the mortgage behind, and then when they die, no insurance, the bank say, hey, time to leave. Then they'd be like, what you mean? Oh, this house is being repossessed because your parents defaulted, they weren't paying. And that's the thing that parents ain't go, some parents will say to children, this is the situation, but and children living in a house with a parent shouldn't have to actually ask and say, well, this is what's happening. If you live there, you should always be abreast because the parents are older on what is going on. And like they say, inherit liabilities, which is, it could be that your parents die, you didn't know the loan wasn't paid off and it was behind, or pension income that is less than they anticipated. Yeah, because national insurance ain't paying you much. So if you're only depending on national insurance to try to pay that mortgage, the bank will take that house because national insurance, the most they can pay is $3,277. And that's the highest you can get from them. No matter how much money you contribute to them, no matter how much years you was there, they work that's the highest anybody can get. So yeah, and then people who get pension from companies who have pension schemes going on, like you pay 5% in, the company pay 5% in. So if you stay there for 5 years or 10 years, you're totally vested. And even when you're leaving with that, it isn't as much. And so you still can't pay off your mortgage. So some people still have to go and take a job here and there, or some people have to still go and take a 9-to-5 job even after retiring. They still have to go take a 9-to-5 job and just to make ends meet. So it happens. That is less than anticipated.
I have a question, Ms. Smith. So
Mhm.
what happened to the life insurance you take out for the mortgage? Shouldn't it pay off the mortgage if, someone died or
Right.
you were unable to pay the mortgage? So
Uh-uh.
what's the purpose of that?
The life insurance is there. And remember, I was saying a lot of times people, because now they have the term insurance, a lot of people now opt to the term insurance because it's less expensive than the whole life insurance. So a lot of people opt to the term insurance, and the term insurance is really taken out for the life term of the mortgage. So that don't do anything if you can't pay your payment. And it only kicks in if the person died, it'll automatically pay off the mortgage. And you have to remember now, some banks, I know back in the days, wasn't even enforcing where people have to put life insurance. So a lot of banks wasn't enforcing that. So a lot of people lost their homes because somebody died and because they didn't have no insurance because the bank didn't enforce it. And then you have situations too where the bank at fault because the bank, a person was insured, they pay their money for their life insurance, they pay their money for their house insurance, all is paid inclusive of their mortgage. Some banks have an escrow account added to the customer's mortgage where a certain amount comes out, goes to the escrow account for the life insurance and for the house insurance. And I think now a lot of real property tax trying to get them to add all them things. And so how do people could ever pay their mortgage off? So that people have escrow. So escrow takes care of the life insurance annually and the house insurance annually. But then you have situations where banks, because they are not doing their due diligence by monitoring to ensure that these payments are deducted from the customer's account and paid to the insurance company, you have situations where policies lapse. I had a situation like that, speaking from a personal experience. My brother, he was terminally ill. Him and my mother had a house in Elizabeth Estate. My mother died, but she didn't have insurance because of her age when she got, and she had high blood pressure and heart disease. So they wouldn't take out insurance on her when she got the mortgage. So my brother had the insurance, and the bank allowed the insurance to lapse, and he had a terminal illness. So the terminal illness that he had, he couldn't get no other insurance. So I was working at the bank, what allowed it to lapse. So they look at me and I look at them. I say, I work here, but let me tell you something. If he died, y'all can give me all the money, pay off the mortgage, and give me the money what left. And so what they had to do, they had to go back to the insurance company, because it was the insurance company's fault too. And so they had to put that amount in a contingency account. So if the insurance company did not reinstate his policy, that money, they made provisions for that money. And so the loan would have been paid off. When he died, the loan would have been paid off. So the insurance company reinstated the policy. And so when he died, everything was okay because the policy was up to date. But you have situations where sometimes the bank and sometimes the insurance company is at fault. And if people don't push, the insurance company or the bank will just put it on them. But I didn't. I worked there and I was like, y'all better fix that. And they did. So when he died, everything worked out. Life insurance, health insurance, or personal payment insurance, PPI, have all been offered as a mechanism to support income. If poor health, death, or unemployment strikes, lenders can rarely insist that a borrower takes out such an insurance. However, and the mis-sale of PPI has damaged public faith in these products. It is doubtful whether this mechanism is particularly well ever regain popularity. One major practical issue is that the bank customer is in debt. Difficulties are highly likely to be experiencing repayment problems with other lenders too. Bank seeks to recover their debt, will be competing with utility companies, that is electricity, water, gas supply, landlord, mobile phone companies, among others, as all strive to get repaid. Yeah, and that's what happens. Everybody wants to be repaid. Yep. Ms. Russell, can you read risk mitigation by banks for me, please?
A bank's credit culture will inform its risk mitigation strategies. A risk-averse strategy might focus only on home mortgage loans or secured borrowing for SMEs, specializing in niche markets such as factoring or invoice discounting, that is, the financing of business-to-business trade debts, or is another option. A leasing company such as a motor credit organization that is part of a motor manufacturing group might finance only vehicles. A full retail bank, however, needs to offer a full range of lending products, and so will employ a variety of techniques to ensure that the risks to which it is exposed do not exceed those determined by the bank's capital adequacy limits, the skills and the expertise of its staff, and its own risk appetite. Figure 12.2 summarizes one of the most common risk management strategies, commencing with the due diligence that must be performed on all loan applications. The information sought at this stage ought to look beyond the borrower at the risk associated with certain geographical areas. Debt recovery is more problematic in some more than in others, and at the risk associated with certain types of products, such as currency loans. The bank's management will decide upon and communicate its risk appetite. A new bank may have an aggressive market share strategy and lower its barriers to risk to gain new business. Peer-to-peer lenders and payday loans companies too may take higher risk in return for higher interest rates and potential profits. Banks lending to business will also limit the total volume of loan assessed tied up in specific industries and avoid lending when those limits are reached. Lending to a portfolio of markets can reduce overall risk. Selling debts is another possibility for banks. For consumer debts, private debt collectors can purchase a debt of, say, 5,000 euros for an immediate cash payment of, say, 2,500 euros. In this way, I think that's euros. No, that's pounds, sorry. In this way, the bank has some money returned to it and avoids the cost of recovering the debt, and it also regains some liquidity, but at the cost of a loss that must be paid from reserves. The private debt collectors is then incentivized to collect in excess of 2,500 to make a profit on the deal. On a larger scale, the bundling up of debts in a portfolio and selling them to hedge funds can be a sensible option to gain liquidity, a practice known as securitization. As we have already noted in this book, however, the proliferation of this practice and a widespread lack of understanding of the underlying assets has been damned as a significant contributory factor to the 2007-2008 global financial crisis. Scrutinizations is consequently unlikely to be seen again on such a large scale. Finally, as we saw in Chapter 11, banks can mitigate their risk by means of security. In the event of default, the ability to seize and sell the secured asset may reduce bank losses, but it should be remembered that this is a last resort. Security does not reduce the underlying risk of the loan proposal itself. Moreover, a bank can suffer a loss of reputation and thus future business if it is seen to have funded a business that is destined to fail on the basis that the bank could inevitably seize and sell its assets.
Okay, thank you. When they talk about bank selling, can sell their debt, yes. I know there's a Scotia Bank. I don't know if other banks have joined, but I know a Scotia Bank sold a couple years ago. They sold their bad loans, their bad debts to Gateway Financial. Gateway Financial is owned by Frankie Wilson. Our Wacombs is owned by them, and they purchased Scotiabank bad debts at a discount for like $100 million. Them along with a Jamaican company or a Trinidadian company. I know it's a Caribbean company, and they purchased Scotia bad loans for $100 million. But what also in them purchasing those bad debt, Scotia gained where, like they said here, they didn't have to be bothered with going behind trying to recover them debts because they sold them all off, where the customers were 1 month, 2 months, 3 months behind, they sold them all to Gateway Financial. And in Gateway Financial, they had a big write-up. In Gateway Financial, having purchased those debt at a discount, what they also do in return, discounted to customers when they actually took the loans over, they discounted the customers' loans. Like some people got discount as much as 30 to 40% of their balances, what they owed to Scotia. And then you had some customers continue with their payments, but then you had some customers who say, sell the house. I ain't being bothered. I'm going to go rent. I get out of that situation. Oh no, y'all ain't coming behind me for no money. I don't care, sell the house. So customers had options to sell, or they, continue with their payment. And on Gateway Financial would do a refinancing of it. And like I say, a lot of people got like a discount on their balances. So yeah, that happened right here. And I think every year or so, Gateway Financial still purchase whatever bad debt that Scotia may have. And like I say, I'm not sure because I haven't seen a write-up for a while if they're doing it for other banks also. I'm not sure. But that's a good way to get rid of it. And like I say, a lot of people choose to say, no, sell it. I don't want it. And like I say, it's really kind of hard when you have invested so much money into a home And at the end of the day, you can lose that home because one incident happened. And like I said further up in the chapter, nothing is certain. And so, it's not certain for the consumer, nor is it certain for the bank, the lender. So, it's kind of hard if you've invested so much money and at the end of the day, because circumstances happen, you're not able to make your payments and can't seem to catch up when the bank, it's just no way out and you have to lose your house and start all over again, and sometimes it's kind of hard, but it happens. And like I say, I feel for persons who in that situations, but here again, you have some persons who are actually, like I say, genuine. And then you have some persons who just don't care. So they'd be like, oh, they come in and, oh, I don't care. They can sell the house. I don't care. They can do what they want. At the end of the day, when the bank actually really wants to sell the house, then they start to cry, where am I gonna live? But you choose to say you're not gonna pay, and it's just as like I said before, with BPL, water and sewage, anything, persons sometimes have their priorities in the wrong place. And so when your priorities in the wrong place, you choose to make wrong decisions, and making wrong decisions like choosing not to pay your mortgage and go on a vacation, or choosing not to pay your light bill and go on a vacation, so it has consequences. So with anything, consequences. Bank actions, considering whether and how to lend is but one point in the bank-borrower relationship. The decision to pursue a non-performing loan through the courts or via insolvency is another. Between the 2 points is likely to be lengthy period of maintaining and monitoring loan. That is the dynamic continuum of the actions and activities that amount to building a strong relationship or at least a better informed one. In illustration 12.3, the early warning signs of problems within the relationship. On a consumer overdraft, credit card, or loans, for example, this could be manifest in several ways, including the following. The borrower makes only a minimum repayment every month. The overdraft rarely goes back into credit. Payments have to be returned or refused for lack of funds. Loan payments are missed. Salary payments are not received. New loans are requested to repay old ones over a longer term. Other creditors take formal or informal action against the borrowers. And like I said before, officers, especially in the credit department, persons who deal with non-performing, like the collection department, and the credit officers, right off the bat, a lot of times credit officers, they still, I guess, some of them still look at customers who they dealt with, and they look at it. And so in the credit department, you'd see where before a loan go bad, they know, because they would create a wish list. And a wish list, like I spoke before, shows that, hey, just to the signs right here, what they're saying, the customer is missed a payment, salary deduction wasn't received. And what happens then, hey, this person, man, they just get this loan, and they pay 3 payments. Then when we look, oh, that person leave, they don't work for government no more. Oh, okay. They on the wish list. No payments coming in. They quit their job. They have no job. So what happens then? These loans default because they're not working in the job where they was. They probably gone somewhere else, but you don't know. So you don't get no salary deduction from them. You have to really hunt them down or figure out where they, get information from probably their previous employer. And somebody may know something to say that, oh, this person went to that company. But other than that, they just dodge. Like we talked about it before in class. Persons has migrated to the US and Canada. They've left and they have loans in like 70 grand. They got consumer loans, and there was a police officer, a nurse, or defense force officer, or a government employee, a teacher. They left and they left that big loan, hoping that they never return to the Bahamas. And like I say, a lot of times people don't understand with loans that are in default. A lot of times people think the bank just say, oh, we ain't checking for that. They have charge-offs, and they have active and they have inactive charge-offs where the banks, those loans are still sitting out there. So a lot of times people feel that I win, but you didn't, and then you're going to come back home and you're going to go to another bank and try to get a loan. And then what is going to happen? And if you want to court, they're taking the matter to court. You don't have to show up, but and the court give them judgment against you. It's going to be there in the court. So when you go to apply for a loan or even a job, some people don't even understand that. I know of a situation where a person applied for a job to a company that they have a charge-off loan, and they didn't even disclose that. Oh, did you have a loan at the bank before? They didn't even disclose that they left, they had a job, came there, was working. But they didn't disclose, they asked them, they didn't disclose that they had a charge-off loan with that same bank where they got employed. And somebody just saw the customer name and they figured out, hey, and they work in collections and they say, hey, this person have a non-performing loan. And person got fired because you come to a bank, you done deceiving the bank because you have a charge-off loan that you choose not to pay, and you come here and you didn't say well upfront and say, I was under situations and I have a charge-off loan here, just be upfront. So she eventually, at the end of the day, lost her job. So people do it, In some instances, the borrower will simply tell the bank that they are having difficulties. A great number of borrowers, however, will try to juggle loans, pretending that there is no problem until it becomes too late to conceal the truth. Monitoring loans and other credit facilities is therefore essential if a lender is to have the greatest flexibility and choice when it comes to taking actions to redress the default and to achieve repayment. Which early warning signs are missed, even some spiral and room for maneuvering is reduced. Note that there is a figure 12.3 and important divisions between private and public actions to recover debt. Where earlier warning signs are noticed and contact with the borrower is established, a lender will have the opportunity to review and rearrange loans to suit the borrower's changed circumstances. Once the borrower becomes more widely known, then other less vigilant creditors may take court action and force the bank's hand. When insolvency action is commenced, not only does the formality and the publicity increase, but also the overall cost of the exercise. And those costs need to be met before lenders receive any funds. And in the case of the borrower who have no assets and no income, who are likely to make any payments in the short and medium term, lenders have to decide whether it's worth incurring yet further costs in continuing to pursue the debt. And so we know that's why you have some people, they just write it off. That's why banks have provisioning every quarter with the financials. They create a certain amount, there's a certain amount of loans they look at and they say, okay, we have like 700,000 worth in that we have to book. This is something they would book. It doesn't say that all the loans are in default, but they book a provision for these loans. So they have to book a provisions for these non-performing, for these loans that person's just not paying the debt. And we know with the legal part of it, like I said before, you look in the newspaper all the time and you'll see this company taking the next company. So they go into, not company, this bank taking a borrower. So they got to go to court to settle what's going on. Legal rules and procedures in relation to debt collections do differ in different sovereign states and the efficiency of such action will often rely on the transparency and accessibility of the court, the availability and the cost of professional advice, legal and registration and regulations of lending and securities, and risk appetite of a bank. In the UK, much of Western Europe, United States, Australia, and those a part of the world that have retained UK-style legal system, such as Singapore and India, the court can be used to collect debt. Typically, where all other means of collections have been exhausted, like most things involving the courts and professional legal advisors, this can be an expensive process. As noted earlier, however, lenders will use the mechanism if it allows them to pursue an individual action against a borrower without sharing the asset or income of the debtor with other creditors. Key debt recovery and insolvency concept. If we look at 12.4, is a basis decision tree in respect to a typical retail bank debt, whether secured or unsecured, or loans or asset finance. That is leasing. Detailed leasing deals with secured lending if the net proceeds of the asset are enough to repay the whole debt. Any surplus will be returned to the owner of the asset or to the holder of a subsequent charge. That is the second mortgage, where there is a shortfall. That is, if the net asset value falls to extinguish the whole debt, the bank may choose to sell the debt to a private collector or to pursue actions through the court. This will often depend on the bank knowledge of the debtor and the likelihood of recovery. So, like I say, the court system is there. I know a lot of banks go after customers like credit card. They have a Commonwealth Bank. It's Russell, Commonwealth Bank, right?
No, ma'am.
Which bank? Credit union?
Yes, ma'am.
Do you all when you work at Bank of the Bahamas, did you all have situations where you all took people to court?
I think we had one or two, but I vaguely remember them. I don't remember hearing of us having much cases like that.
Because I know when I work at the bank at Finco, I used to have to go to court for the bank because it wasn't for mortgages. It was just for persons writing bad checks or persons taking money. It was like I had a guy that I had to. I mean, we had to find this guy every time the police tried to get him. He couldn't get him. We finally got him. I had to go to court. Man, I was in that Nassau Street court from Mussy 6 o'clock until Mussy 11 o'clock that night before that case is fought. Man, you hear more stories with mothers taking sons to court for their money. You hear Commonwealth Bank taking for their credit card, for their loans. So yes, you have that, and they go to court, and some persons are awarded judgment, and the judge look at the person, the borrower, and say, how much you could afford to pay the bank every week? Oh, Your Honor, I could only pay them $10. So that's all the bank get from them, $10 a week. They get the judgment, but the person say, I can only afford to pay $10, and that's what happens. Like with anything, you carry somebody to court, and the person say, I can afford to pay that. And if they look at the person paying, and really truly that's all the person can afford to pay, you have to accept it, $10 a week. So you just, I guess, sit there and let that $10 fill up, and if the person owe you plenty money, you may croak before the person finish paying you. So that's the court system. This will often depend on the bank knowledge of bank. In the case of asset finance, such as the lease of a car or finance company, they also sell the debt. but is more likely to repossess the car, sell it on the market off the market value, and then account for any surplus or shortfall as with secure lending. Where a national legal system works well and not burdened by costs and delay, debt recovery proceedings in the courts can be swift and effective. The opportunities to delay corruption costs in such less efficient regime, however, can prevent lenders from pursuing debt in this way, and may even deter them from lending in the first place. When commercial contracts span nationally border, they can stipulate that a legal system other than that of the country in which the company domicile be used. The UK, particularly London, is a favorite legal destination for commercial dispute because of the wealth and the experts in the profession in London and the transparency and a relative speed of the legal process. This is unlikely to affect consumers' debt, but a loan agreement between, say, an Indonesian borrower and a Vietnamese bank may be, may be determined in London. So we see a lot of times people don't even want, they prefer to hear the case abroad. And I guess these jurisdictions, I guess they have the right to be able, they have laws in place that they can actually do that. All right, Miss Cynthia, is your mic working yet?
Yes, ma'am, my mic is working. You can hear me?
Yes, I can.
Okay. Formally in civil.
Solvency.
I'm sorry.
I was just telling you what it was, insolvency.
Oh, sorry. Formally, insolvency action is the last line of defense for banks trying to recover debts. Court action can still result in shortfalls of debt for which the borrower remains liable. Court action ends only when either the loan is fully repaid or the creditor finds an economically to collect the shortfall by constructing formal insolvencies in sorry, such a mechanism that brings an end to debt contracts and effects of if the loan are not fully repaid following an insolvency procedure, no shortfalls can be collected even by legal means. The procedures of formal insolvencies like civil court action for debts are fairly similar worldwide and are guided by the key principle noted earlier. See key debts recovery and insolvencies concept for individuals and companies. It can take several forms. Table 12.1 lists the options available in the UK, but it should be noticed that terminologies differs between countries. In the 1980s and the 1990s, the legal system of the world began to coverage of the idea of insolvency should help stricken business and individuals to recover and to become part of the credit world once again. In most jurisdictions, the two routes for individuals and companies lend them either to the end of the road, that is bankruptcy or liquidation, or towards recovery. That is the individual voluntary agreement, IVA, the company volunteers agreement, CVA, or administration. All too often, however, the problem that have led to over indebtedness is the insolvency is proved interactable and those cases unevictable reach the end of the road.
Let's continue about the world. We have to look at some stocks in the 120 and solvency prices. It's just and today was
I can't hear you, Miss Smith.
So I was saying, just continue by the World Bank. You don't have to go to the chart, just go down to the other paragraph, the World Bank.
Okay, the World Bank, through its various organs and very interested in the efficiencies of legal and professional process in debt recovery and insolvencies, and the publish regular reports on the efficiency of the national system. These serve to inform creditors and lenders of territories in which debt recovery may be more problematic and help national government to perceive areas in which legal changes might improve recovery rates. Figure 12.5 shows the average recovery rate in selected countries is no more consider con, consider sorry con Sundays that regains the lower recovery rates are also those with less efficiency legal system and smaller populations of professionals such as accounts and insolvency specialties.
Okay, thank you.
Right.
So you have to look at this table 1.2, where it talks about the terminologies, talk about the impact, the national variance. It talks about the out-court settlement, the liquidation of companies, the company's voluntary arrangement, and the administration. You can just peruse that and look at that for your understanding or just for some knowledge. Ms. DeVoe, can you just read this last portion for me, please? The implication of bad debt recovery for retail bank.
My phone. Okay, 1 minute.
Okay.
The implication of bad debt recovery from retail banks. Finally, in this chapter and in this book, we consider the final act in the bank-borrower's relationship. The instance in which the borrower can not or will not repay the bank must rely upon security. For business borrowers, this may involve the liquidation of their business. By following the divine, that is, deposit investigation, valuation, authorization, and notification procedure for perfecting security, see Chapter 11. The bank will have put itself in a position in which it can force the sale of the secured asset. In this way, the bank can act without the approval of the security depositor, but it will normally issue notice that it intends to force the sale by making formal demand for the repayment of the loan outstanding. In most jurisdictions, the bank have a further duty to ensure that it gets the best possible price for the asset. When a decision to sell is taken. In the event of a social economic downturn, however, there is normally no duty to wait until better prices emerge, because any gains from doing so will often be wiped out by the continuing accrued of interest on the outstanding loan. When domestic property is concerned, repossession can lead a bank to evict the borrower from their home. For a business, it can mean job losses. Both instances involve reputational risk to the bank, and lenders must take care to minimize the bad publicity that can accompany this type of enforcement action. This chapter has dealt mainly with the practical how to maximize the recovery of non-performing loans or bad debt. This is clearly important and has implications for shareholders' wealth, bank profit, and capital adequacy requirements. In retail banking, however, financial loss is inevitable. It is maximizing that loss that is key to success. Now that you have studied this chapter, you may want to test your understanding by considering the case studies in Appendix C.
Alrighty, thank
Oh,
you. Yep, we're finished. So like I say, exam is on the 28th at 6 o'clock at BIFS. The exam is from chapter 7 to chapter 12. And I have one more assignment for you, which I will try to send to you tomorrow, which will, I'll make up my mind whether I'll just do the assignment or I will give you the review sheet. So by tomorrow, I should be able to tell y'all which I'm going to do. But the exam is from 6 to 9, and it's chapter 7 to chapter 12, and it's true and false and multiple choice as the midterm was. So once the exam is done on the 28th, I try my best to mark the papers by that Wednesday, but like I'm not able to give results. BIFs always prefer they give the results out, but I'll be able to say to either of you, if anybody, got below 64, which I don't think will happen. Yeah. So it was my pleasure, and I hope y'all learned a lot, and I was kind of helpful in disseminating the information to you. But it was my pleasure. But like I say, the exam, and I'm not there, Miss Dean or Mr. Pratt or Miss Johnson, or Francis from the office will actually invigilate the exam. So same as when you took the midterm. And then well, this time I'll go there and pick up the papers. She won't scan them to me. I'll go and pick up the papers and take them back, because I'm not allowed to keep the final exam. So I'll pick up the papers and then take them back to them, because they're actually cross-marked. And that's the reason why I say I can't give you all any results. Okay? But any questions, any concern, anything you want to add before we sign off? Any of you?
Miss Smith, it was a very interesting class, and a lot of things that I thought I knew, you was able to, give a better understanding. So thank you for that.
My pleasure. And the midterm for the 2 persons who have to take it is on Saturday at 10. Miss Dean will be doing it at BIFS, okay? Anybody else have any questions or any concern regarding the exam coming up, or anything you want to add or discuss before I sign off?
No, ma'am, no
No,
questions.
ma'am.
Alrighty. Well, like I said, it was my pleasure, and wish you all well in the final exam, because that's 50% of your grade. So I wish you all well in the final exam. But like I said, I'll let you know, each one of you individually, whether I'm going to do a review sheet or whether I'm going to give you another assignment by tomorrow. Okay. Alrighty. Take care. Have a great night.
Thank you, Ms. Smith. Have a good night.
Good night, Miss Smith.
Okay.
Good night.
Good night.
Good night. I learned a lot, Miss Smith.
That's good. Bye. Okay. Take care.
Yeah, you too.